Good morning. Construction cost overruns and the financing risk and what borrowers need to know. And most construction projects don't fail because of the deal, they fail because the budget was wrong or the timing was wrong. And if you're building, renovating, or developing real estate, construction cost overruns are one of the bigger financial risks you could face. And lenders know it. And from a financing perspective, cost overruns aren't just an inconvenience. They can break your loan, kill your returns, and force you to bring more cash to the table. And let's break down how lenders are going to view this risk and how smart borrowers can structure their transactions around it. So, why construction cost overruns are so dangerous? And in today's environment, especially in markets like Houston, construction costs are volatile. And with potential labor shortages or swings in material prices because of the conflicts or permit delays or change orders mid project, even a 5 to 10% cost overrun can completely change your deal structure. And here's why. So, your loan is going to be based on a fixed budget loan to cost constraint, and your valuation is based on your projected NOI. And your exit depends on hitting those numbers. But if cost goes up and rents don't, your entire capital stack will get squeezed. So let's talk about how lenders underwrite construction risk. And lenders aren't guessing, they're really just underwriting downside. And here's what they will focus on. So, loan to cost or LTC, most construction loans sit around, say, 60 to 70% loan to cost. And what that means is you're bringing 30 to 40% equity, and any overruns, that's going to get pushed back to you. And the key insight there is that cost overruns don't get financed, and they get funded by you, the borrower, out of pocket. So be prepared for it. And there's usually a contingency reserve set up specifically for this requirement. And most lenders are going to require a minimum 5 to 10% contingency that gets built into your budget. But here's the reality, that buffer can disappear quickly when there's change orders or site issues, or there's delays in the project and your interest expense is going up. And if your contingency is thin, lenders can see risk immediately. 3, interest reserves. Many construction loans, and not all, will include, say, 3 to 12 months of interest reserves. But if your project gets delayed, you can burn those reserves faster, and you may need to inject additional capital. 4 is exit risk, and that's the real problem. And this is where most borrowers get it wrong. And if costs increase, your basis is going up and your debt coverage goes down, which leaves you with less refinance options that are available. And lenders are asking, can this deal refinance at today's rates? And if the answer is no, your deal's at risk before it even starts. So let's look at a real world example. And let's break it down. Say we have an original project cost of $2 million and you get a 65% loan to cost loan, so $1.3 million, and you bring in $700,000 in equity, usually in the land. Now, if you add a 10% return, that's $200,000. So the new cost is $22.2 million and you're needing $900,000 because of that cost overrun. And that's a 28% increase in the equity required. And most borrowers just aren't prepared for that. So, how smart borrowers can protect themselves. And this is where strategy separates amateurs from professionals. So, we want to underwrite with conservative costs. So, if you want to budget for a little bit higher on labor materials estimates and assume for delays and build in real contingencies. Don't underwrite to make the deal work, is the bigger point. 2 is structure your liquidity up front. The lenders want to see post closing liquidity, which is reserves that are available. And liquidity is flexibility for when things go wrong. 3, lock in pricing where possible. Think fixed price contracts or guaranteed maximum price agreements, GMP agreements. And this will transfer risk away from you and onto the contractors. 4, focus on the exit from day one. So let's ask, what does the debt coverage look like at stabilization? And what happens if rates stay higher? And can I refinance this loan safely? The point is, structure beats rate every time. And 5, work with the mortgage broker. And most borrowers go to one bank, whereas professional brokers can shop multiple lenders, structure interest reserves if available, and negotiate contingency requirements, but also really just aligning your financing with your business plan. And this is where deals get saved or lost, call me and we can fix it. Final takeaway for the day is that construction cost overruns aren't a what if, they're a when. And the real question is, did you structure your financing to survive it? And if you're building, renovating, or developing, strategy matters more than ever. And that, my friends, is it for the day. Please visit my website, billraponline.com, to figure out how to get a hold of me. I'd love to talk to you more and figure out how we could help. Take care.